Interpreting central bank speeches and meeting minutes is essential for traders aiming to anticipate market trends effectively. These communications offer critical insights into potential policy moves, helping traders position themselves strategically and manage risk proactively. Firstly, pay close attention to key phrases frequently used by central banks, such as data-dependent, appropriate to tighten, patient approach, or policy normalization. Each phrase carries specific connotations about future policy decisions. For example, if a central bank shifts language from patient to prepared to act, this subtle change signals increasing urgency for policy action and can prompt immediate market reactions. Next, monitor shifts in tone. Even small adjustments in a central bank's tone, such as moving from optimistic to cautious language or vice versa, can significantly influence market sentiment. Tone changes often precede concrete policy moves, offering early warnings to traders. It's helpful to track how tone evolves across multiple communications to gauge momentum towards a potential policy shift. Another important factor to observe is dissenting votes within the meeting minutes. Dissent indicates differing views among policymakers, potentially foreshadowing future policy direction. An increase in dissenting votes could imply upcoming policy shifts or heightened uncertainty, influencing market volatility. Traders should note whether dissenters advocate more hawkish or dovish positions, providing clearer signals about potential future moves. Additionally, closely analyze the dot plot, projections provided by the US Federal Reserve. This visual tool outlines individual policymakers' forecasts for future interest rates. Significant shifts in these projections can immediately alter market expectations about future rate moves, leading to sharp adjustments in asset prices. Pay special attention to the median forecast as well as the outliers to understand the full range of policy possibilities being considered. It's also important to contextualize central bank communications within broader economic indicators and global market conditions. For example, if central bank rhetoric remains hawkish amid softening economic data, markets might price in increased risk of policy errors or heightened volatility. As a practical example, let's decode a recent speech by the Federal Reserve Chair in plain English. Suppose the Fed Chair said, "We see persistent inflation pressures and will act as appropriate to maintain price stability." In straightforward terms, this suggests the Fed is leaning towards raising interests further if inflation does not ease, signaling to traders a more hawkish stance that could strengthen the dollar and pressure stock markets. In summary, carefully analysing central bank communications, focusing on key phrases, tone shifts, dissenting votes, dot plot adjustments, and broader economic context equips traders with invaluable insights, enabling them to anticipate market movements, manage risk, and optimize their trading strategies effectively.